Okay, so I'm gonna go over a investment strategies comprehensive guide. This basically this presentation that is made with AI, and we're just gonna go over it and see how useful it is. And I did give it some prompts, so let's see how much it really tells us. So I think there's not a way to get a laser, but okay, let's just go through it. So mastering investment strategies, a comprehensive guide. So explore essential investment concepts and strategies to enhance your financial journey from portfolio theory to AI-driven insights. Okay, so what's the first thing? Investing, a foundation for financial success. Okay, so understanding the basics of investing is crucial for building wealth. Clear financial goals provide direction and motivation, guiding your investment choices and strategies. This foundation helps you navigate the complexities of personal finance and sets the stage for long-term success. So we have passive investing, which is a hands-off approach, and then we have active investing, which is the hands-on strategy. So passive investing involves strategies like exchange trade funds and index funds that aim to mirror the performance of a specific index or benchmark. This approach typically results in lower fees, less frequent trading, and more hands-off management style, making it accessible for beginners and cost-effective in the long run. And we have active investing, which is requiring investors to actively select stocks and manage their portfolios with the goal of outperforming the market. This strategy can lead to higher potential returns, but it often involves higher fees, increased trading activity, and requires more knowledge and time from the investor. Asset allocation made simple. How do you balance your portfolio? So we have understanding asset allocation. This is distributing investments across various asset categories to manage risk and enhance returns. A balanced approach considers individual risk tolerance, investment goals, and market conditions. We have the role of stocks, which typically offer higher potential returns but come with increased volatility. Allocating a portion of the portfolio to stocks can help capitalize on market growth. We have the benefits of bonds, so they provide stability and income, acting as a counterbalance to the volatility of stocks. Including bonds in a portfolio, they can reduce overall risk. We also have alternative assets, which are like real estate, commodities, and cash, which can further diversify the portfolio and provides additional risk management and potential returns. So that's how you balance the portfolio. We have spreading investments, which reduce risk. So diversification involves spreading investments across different asset classes, such as stocks, bonds, and real estate. This strategy helps mitigate risk since not all asset classes perform poorly at the same time. By having a diversified portfolio, investors can reduce the impact of volatility in any single investment or asset class. You have long-term performance benefits, which is historical data shows that diversified portfolios often outperform concentrated investments over the long term. By including a variety of asset classes, investors can benefit from different market cycles and conditions, leading to more stable returns over time. You can understand correlation for effective diversification. This requires understanding the correlation between different asset classes. Investments that are not closely correlated can provide better risk reduction as they respond differently to market conditions, which further stabilizes portfolio returns. So we have the power of diversification, risk reduction strategies. So you can spread the, oh, this we already went through. It's just going it in more in depth. Okay, what do we have next? Understanding modern portfolio theory, balancing risk and return. So we have modern portfolio theory, MPT for short, is a foundational concept investment strategy that illustrates how investors can construct a portfolio to maximize returns based on a given level of risk. It emphasizes the trade-off between risk and return, asserting that an optimal portfolio can be achieved by diversifying investments across various asset classes. The efficient frontier is a key concept within MPT, representing the set of optimal portfolios that offer the highest expected return for a defined level of risk. So let's go through the key risk management strategies for investors. So there's understanding volatility, which refers to the degree of variation in assets trading price over time. Understanding volatility helps investors gauge the potential risks associated with their investments, prepares them for market fluctuations. We have the role of beta, which measures an asset's sensitivity to market movements. A beta greater than 1 indicates that the asset is more volatile than the market, while a beta less than 1 indicates less volatility, allowing investors to assess risk relative to market changes. So we have implementing downside protection. Downside protection strategies such as stop loss orders and options help minimize potential losses in declining markets. Implementing these strategies ensures that investors can safeguard their portfolios against significant downturns. So, portfolio optimization, refining your investment mix. Use strategic tools and theories to enhance investment performance over time. So, in Q1 2023, for example, you can have introduction of new portfolio optimization tools that help investors analyze risk and return more effectively. In Q2, there was adoption of modern portfolio theory concepts to align investment strategies with individual risk tolerance. Q3, there was integration of AI-driven analytics to optimize and monitor investment portfolios in real time. Q4, there's review and adjustment of portfolio allocations based on performance metrics and market conditions. And then we have deep dive into ETFs and index funds, structures and benefits. So what are ETFs? Oh, I guess it doesn't. Let's go back. What are ETFs? They're basically exchange traded funds or investment funds that are traded on stock exchanges similar to stocks like the S&P 500. They typically track an index, commodity, or a basket of assets, offering both diversification and liquidity. Understanding index funds. So index funds are mutual funds designed to follow a specific market index, such as the S&P 500. They aim to replace the performance of the index rather than outperforming it, making them a popular choice for passive investors. So I guess the stock exchange is probably TSX, like the Toronto Stock Exchange or the NYSE, rather than the S&P 500, because that's a market index. Cost effectiveness, both ETFs and index funds offer lower expense ratios compared to actively managed funds, making them cost effective options for investors looking to grow their wealth over time without high management fees. Examples of ETFs and index funds. So common examples of ETFs include SPDR, S&P 500, ETF SPY, and Vanguard Total Stock Market ETF, while popular index funds include Vanguard 500 Index and Fidelity 500 Index Fund. They're widely used for beginners and seasoned investors. So you have the capital market line, a vital link in investment strategy. So this is illustrating the relationship between risk and expected return in a well-diversified portfolio. It represents the risk-return trade-off for efficient portfolios that combine risk-free assets and market portfolios. Investors can identify the optimal portfolio by finding the point of tendency between the capital market line and the efficient frontier, guiding them towards maximizing returns for a given level of risk. So we have AI-driven analysis